Hello everyone. I will cover Chapter 2 in this lecture. Chapter 2 is about insurance and risk. These are some of the concepts that we will cover in this chapter. We start with the definition of insurance. Insurance is the pooling of fortuitous losses and transfer of risk to insurers who will indemnify insured for such losses. So we look into these concepts in detail. So what are the basic characteristics of insurance? Pooling of losses, payment of fortuitous losses, risk transfer, and indemnification. Pooling of losses means a large number of entities, individuals or businesses are taking insurance and few of them are suffering losses. So the losses are spread across a large number of customers. So let's take an example. There are two businesses with identical buildings, each valued at 50,000. There's a 10% chance of the building getting destroyed. That is 10% chance of 50,000 loss. Hence, 90% chance of zero loss. So what is the expected loss? 90% into zero and 10% into 50,000. So it is $5,000. So we use similar logic to calculate the standard deviation. Now, if two business owners come together and pool their losses. In this case, the expected loss remains the same, that is 5,000, but the standard deviation decreases. It was 15,000 previously, now it is 10,607. So what we notice is that as the number of entities increase who are pooling their loss expense, the standard deviation declines. That is, the measure of objective risk is declining. So in a way, it is risk management. Why is it possible? Because of the law of large numbers. The law states that if there are greater number of exposures, in this case, insured entity, they will better match the results expected from an infinite number of exposures or infinite number of. The other characteristics are payment of fortuitous losses. Fortuitous loss means something that happens by random. It is not deliberate, it is not pre-planned. If it is deliberate or pre-planned, it is not covered by insurance. Risk transfer means pure risk is transferred from the insured, that is an entity like individual or business, to the insurer, that is the insurance company. Typically, the insurance company is in a better financial position compared to its customers. The final characteristics is indemnification. Indemnification means the customer is restored to their initial financial position prior to the loss. So what are some of the characteristics of insurable risk? Risk that can be insured. First is large number of exposure units. That is, large number of entities are likely to face that loss and hence they will opt for insurance. But a few of them will actually face the loss, so the losses will be spread across large number of exposure units. The losses should be random in nature. It cannot be deliberate and the losses should be determinable and measurable. So that will help the insurance company to decide how much it needs to pay out in case of loss. There should be no catastrophic loss. That is, when pooling happens with large number of exposure units, we can expect that large number of exposure units will not be affected. Only a few number of exposure units will be affected. If the loss is catastrophic, that leads to large number of exposure units getting affected, then we have to use reinsurance. The next characteristics is the chance of loss should be determinable or measurable. In that case, the insurance company can determine a sufficient premium to be charged from customers. The premium should be economically feasible. Okay? The customer should be able to afford and purchase the policy because the premium is affordable. So based on these requirements, we notice that personal, property, and liability risk can be insured. Market risk, financial risk, operations risk, and political risk are difficult to insure. Let's look at an example, that is fire. We try to determine whether fire is an insurable risk. We look at the 6 characteristics and whether fire satisfies those characteristics. Similarly, for unemployment, whether it satisfies the 6 desirable characteristics and hence whether it is an insurable risk. So I will stop here and I will continue with the rest of the chapter in the next lecture. Thank you.